One of the most commonly asked questions we come across is whether you should buy a property in your personal name or through a limited company. In this video, we're going to break that apart in great detail and get a better understanding as to where you should be building a portfolio of many properties or a single property. What's the best place to buy? And what's going to be best for taxation? And what's going to be best for maximizing the amount of net cash flow and income you pull out of the property? Let's cover it in this video. Hey, it's Gary from Let Property, and we help thousands of landlords every single year buy and sell their tenanted property through the sale of buy-to-let investments here in the UK. I personally own a multiple seven-figure property portfolio myself, and I'm here today to guide investors just like you on the path of becoming a hands-off and successful property investor just like me. So first of all, I want to put a disclaimer on that this is not tax advice. I am not an accountant. I'm just a guy on the internet. So if you're looking to buy in a personal name or limited company, you should speak to an accountant or someone who's qualified to give you proper tax advice. But here, what I'm going to show you is I'm going to show you my personal experience, my personal understanding, and perhaps give you some tips from the perspective of a property investor. So why would you even think about this argument? Why would you buy in your own name versus a limited company? Well, the main reason is because of taxation. If you own something or a property in your limited company, the income that that asset produces will come personally. You will effectively add the income on that to your personal income at the end of the tax year. However, if you buy something in a company, what that means is that the income that that asset generates goes into its own entity, and that company is now producing an income, and that profit within that company at the end of the tax year is subject to corporation tax. Now, the one real advantage of having your income coming through a company versus personal is that there's a lot more expenses that you can put through in a company environment versus a personal environment. However, if you have the income coming personally, it means that there's a lot more things that you can actually spend that on for your own personal lifestyle. So there are benefits to having both, but in a corporation environment, generally speaking, you'll be able to save a lot more in taxes in the tax year directly because you have it in a company. So there's so many types of expenses that you could put through in a company against the rental income. Let's just say, for example, you generated £100,000 in rental income in a tax year, and that was within a corporate environment. That would mean that there's so many other expenses you could take off of that. One of them being interest payments for the property. You can't do that in a personal environment now as of a couple of years ago due to Section 24 tax changes. So you could take the interest payments off of the income that's generated. You could also take expenses for travel. You might be traveling between properties to look for different investment opportunities. Again, travel expenses could be subject to corporation tax relief because you're actually basically operating that business and using that money to operate that business in a better way. So obviously this makes buying in a limited company sound amazing, but what are the downsides of doing so? Well, the money used to purchase the property needs to be within the limited company for a start. So you would need to effectively, if you had that money personally, you could lend that money to your limited company, or that limited company would have to produce enough money for a deposit or for the cash to actually purchase the property. That's the first consideration. The next thing to consider, which is one of the main downsides, is that if you're lending within a limited company environment versus a personal environment, there's generally going to be much higher lending costs within a limited company here in the UK. And normally what you'll experience is a 2% roundabout increase in lending costs within a limited environment versus personally. And one of the things that's staggeringly funny about that is that even though you're spending more on the lending within a limited company, at the time of recording this video, a personal buy-to-let mortgage might be at the range of 5% interest per annum. Limited company, you're probably 6.5% to 7% interest per annum. And what's hilarious about that is even though you're buying it within the limited company, you will still be subject to a personal guarantee on that loan. So you will still be personally liable for any debt within your limited company with just about 99% of mortgage lenders here in the UK. You also need to consider that when you run a limited company versus a personal business and you're putting a self-assessment in at the end of the year, generally you're going to need to employ an accountant, and there's going to be costs and additional work required to running a limited company, which you have to factor in the costs of too. So really what you need to look at if you're buying in a limited company versus personal is like, is the cost of running a limited company, the additional interest payment costs, the additional accountancy costs, those are going to be your main ones, is that actually worth it for the taxation I'm going to save? And does this actually fit my long-term plan to do things this way? Because what's very important to remember is that when your limited company produces money and you want that money personally, that will still be subject to income tax, okay? You could take that out in the form of an income as an expense within the business, or you could take the profits within the business out as dividends, and that would still work out around the same as just taking an income. So when you take that money out of the company, it's effectively going to be the same as owning the properties personally and just paying income tax on the income that they produce. So this is why when it comes down to this argument, it very much is done on a case-by-case basis. And the best advice I can give you is to go and speak to an accountant. It is important to remember that starting a limited company can be done very, very quickly. You can have a limited company up within a couple of days, and then you can literally have a bank account. You can go and use something like Wise to get a bank account very, very quickly. So you can operate and start a limited company very quickly. So you could even agree to buy a property. In completion, you could go and speak to an accountant and you could resolve this issue. So you don't need to worry about this as a matter of urgency before you start in your investing career, but it is definitely something that you will need to work out. And the reason why this is done in a case-by-case basis is what it really comes down to is like, how much personal income do you have? How much personal income do you need? Okay, and what taxation are you paying at the moment? If you need all of the money from your property income coming personally and you don't really make any other money personally, then it might make sense just to buy the properties personally, because if you're not buying many of them, the additional cost doesn't outweigh the taxation benefits because you'd be taking all the money out of the company anyway. And on the other hand, if you're trying to build wealth in a long-term plan, which many people probably watching this channel will be, in most cases, it's going to make sense to have a limited company to do that, because you're going to be able to save in the long term and keep a lot of the profitability and the profits within that company. There's going to be a lot more expenses you can take away from that company. And that has been my experience, is that there's a lot more tax savings to be had when you operate a property investment business within a corporate environment versus doing this personally. For those who don't know, my personal experience was I had a large liquidity event a couple of years ago when I sold my marketing agency, and that provided me with a lot of personal money. And I didn't even need to take a lot of lending out on many of the properties I purchased. So I took a lot of that personal money from that liquidity event, which I did pay a lot of tax on, and I took that money and I lent it within my property limited company. Then that property limited company bought those properties, and then all the income that those properties generate is now stays within that corporate environment. That now means that I can expense things, because I have traveled to different parts of the UK to look at different investment opportunities. There's different expenses that I can put in against that, which has actually resulted in me having a lower tax liability at the end of the year, because there's genuine business expenses that I have against the rental income of that portfolio. So many investors that are looking to retire or build a supplementary income will really look at the company route, and it is an area that you should look at seriously in the UK. So my best advice, go and speak to an accountant, go and find out what's best for you. But hopefully this video gives you a sort of rundown as to kind of the differences between both and the main things you need to consider in terms of costs and benefits at each side. I recently shot another video on how to find your next best property investment deal. If you're ready to go, just click the link up here to check out that video.